welcome back to Weekly. Joining me now to chat about gold and Teranga Gold, the mid-cap gold stock that perhaps you haven't heard of before, is Richard Young, the founder and chief executive of Teranga Gold. Thanks for joining me on Weekly.
Andrew, it's great to be here.
So I got to show this 10-year graph of gold. What a day to have you on Weekly. As viewers can see, on the right-hand side of the graph, gold has poked through a pretty heavy-duty resistance level of $1,600.
Yeah, absolutely. It's a great day. I mean, well, part of it is the coronavirus taking hold, but gold has been moving up over the last 6 to 9 months on the back of lower interest rates for longer and a decoupling with the U.S. dollar.
Now, when you look at that decoupling with the U.S. dollar, I'm going to show our viewers this picture, which shows the inverse of the Dixie against the price of gold, and gold is on the left axis. And why do you think on the right-hand side that the two have decoupled? Because historically, a weaker U.S. dollar meant higher gold, but now we're seeing a stronger U.S. dollar and stronger gold. What's going on?
Well, you know, the U.S. former Fed Chairman Alan Greenspan was on CNBC back in September, and what he talked about was the fact that you've got over $17 trillion of negative yielding debt, and that investors were going to move into asset classes that they knew would have value 20 to 30 years out. So the 30-year Treasury has done very well, and gold's done well. Those were the two asset categories that Alan Greenspan mentioned in September, and that's really coming to fruition. And that's why you're seeing gold prices move up despite where the U.S. dollar's at.
Now, demand has shifted. You've seen central banks buying more gold, arguably to get away from the U.S. dollar. Jewelry demand has been soft in a couple of traditionally strong jewelry companies. But on the supply side of gold, if I were to show our viewers a graph of the average grade mined, I mean, basically it's been down to the right for not years, but decades. And I assume that the supply of gold isn't growing. Is that fair?
That's correct. So as an industry, we've underinvested in the sector for the last decade or more. So you're right. Grades are declining. We built more lower grade deposits than ever before, but that's coming to an end. So what you're going to see over the next decade is declining mine supply and higher costs because of those lower grades.
Now, what about hedging? Companies used to hedge gold a lot whenever you saw a spike, but my sense is companies have lowered their cost structure right across the board, and perhaps that's one of the reasons that they seem to generally hedge a lot less. So even though gold's moved up, my suspicion, and I'm asking not telling, is gold companies probably won't do a lot of hedging here.
Yeah, Andrew, that's correct. So if you go back in the day, I used to work at Barrick. You had higher interest rates. Contango was 7%. Gold prices were flat. It didn't, you know, it made complete sense to hedge. Today it doesn't. Low interest rate environment, you're not really gaining any contango, and the risk is, as we've seen, that gold prices can move materially higher, and if you don't hedge your costs, you can be on the wrong side. So the industry's cut costs and is in a much better position and no longer requires the hedging that it did years ago.
Now, I know that as a developing company, you did do some hedging, but now as you move into, you know, mid-tier status, producing, call it 350,000 ounces of gold during 2020, going north of 400,000 ounces in 2021, has your philosophy towards hedging changed?
Philosophy is the same. We did some short-term hedging as we were building our second project. Again, as a single asset producer, we wanted to secure cash flows to make sure that we could fund that project. That's now complete, so we no longer have the requirement to be able to hedge as we move forward, and we'll take advantage of these higher gold prices as we move forward.
So when I go through your slide deck on your website, I sort of get the sense that, you know, your modus operandi is to be an open pit producer in West Africa. Tell us a little bit about Teranga Gold.
Well, when you look at West Africa, they're part of the West African Economic and Monetary Union, so they're almost like provinces in Canada. So again, the same legal structure, the same language. It's very easy for us, and there's a lot of synergies with working in the region. So we're focused in Senegal, Burkina Faso, and Cote d'Ivoire.
Yeah, so I'm showing our viewers a picture, a map of West Africa. Burkina Faso hits a lot of headlines, just like Mali does. So why should that not scare me off of your company, at looking at shares in your company, which I want to disclose to viewers. My hedge funds at Forge First do own shares in Teranga Gold at this point in time.
Well, you know, unfortunately, Burkina Faso has been an issue over the last 3 or 4 years with the increase in terrorism. That's to the north and east. We're located in the west. We're about 800 kilometers away from that. We have not had any incidents, but despite that, we have increased our security protocols that do add about $25 an ounce to our cost structure.
So have you ever had any work stoppages, fatalities, or other incidents related to terrorism in Burkina?
No, not all. So we built our second mine, Wayon, and we did not incur a single lost time injury through construction or operations. We've had no issues with terrorism or work stoppages in the country.
Period.
Period.
Ever.
Ever.
What about the fiscal regime in Burkina?
It's very supportive, as it is in West Africa. One of the reasons why we like West Africa so much is a very fair, modern mining code with stability agreements. The tax rate 17.5%, and our royalty rate is 5%, which is consistent as it would be around the world.
So you pay 17.5% taxes on the operating profits generated within Burkina.
That's correct.
And then in addition to that, you pay a royalty.
That's correct.
So when you stack up those rates relative to the rates in, call it, more punitive countries in Africa to do business, where does Burkina Faso, where does it stack up?
Well, it's on, well, globally, not just in Africa, but it's on the right side of the ledger. It's a low tax regime.
But it's a high enough tax that you could look me in the eye and say, I don't think we're going to get taken to the cleaners because of the new regime coming in?
No, we've got fiscal stability. That's one of the benefits of being in West Africa, is you have fiscal stability built into your mining convention for the life of your assets.
Okay, thanks.